Welcome back, everybody, to another episode of Alt Reports Radio, where I'm very happy to be on here today with Martin Saenz of Bquest, which is a fund that he runs there. We're going to dig in and learn about what he's investing in and why and all that. So, Martin, thanks so much for jumping on here. I really appreciate it.
Thanks for having me on, Breck.
Now, you were a referral from Brett Berkey, who runs PaperStack over there, which is a great platform if you're somebody who's trading individual notes, mortgage notes for the most part. Have they ventured outside of mortgage notes yet? I'm not sure.
I think they deal with business notes as well,
Okay.
and land leases and some
Fantastic.
other aspects of real estate. Yeah.
And so he had great things to say about you, said that you and I should chat, and made an introduction. So I'm thrilled to have you on here. Tell me a little bit about what is the fund that you have and what are you investing in?
Sure. So I'll tell you probably first, maybe go into some of the origins of how I got into this mortgage note space, if you will.
Okay, so it's mortgage notes is the whole fund.
Mm-hmm. The whole fund is on. We buy pools of reperforming owner-occupied residential mortgages from across the United States, in tertiary and suburban markets. So we're pretty much in every state, and our average fair market value for a property is about $370,000.
Okay.
So what's meant by reperforming is these are individuals that receive mortgages at major lending institutions like Wells Fargo or PNC. The homeowners ran into a life circumstance. The mortgage became non-performing at some point due to divorce or health or a loss of job. And then at some point, a hedge fund or another lender got them back on track with a loan modification. These individuals, which are good individuals, they start paying again on schedule, and over a period of 12 months, 24 months, it becomes re-seasoned and performing again.
Okay.
So we'll buy those into our income fund at an 11, 12% yield. Wow. And pay out a 9% annual pref to our investors, paid on a monthly basis.
Okay. So then, yeah, let's talk about how you got into that. How did that come to pass?
Sure. So like yourself, I had my wife and I, we founded a company. It was a government contracting company at the time in 2005. And we built that up over the course of years, selling products and services to the federal government.
Okay.
And over the course of time, we started acquiring commercial and residential properties as landlords in the DC area. And in 2013, after just a lot of stress selling to the feds, my wife and I sold the company at a very good point. And I had capital and I wanted to do something different. And what I knew at the time was I wanted to do something that had more impact on society. And also I wanted to not have as much stress associated with the income I was generating, because selling to bureaucrats is very stressful. Sure. And so, I didn't know it at the time, but, I didn't understand the mortgage side at the time. But a few months after selling the company, I was at a real estate club and I ran into Note School, that's an educational platform. And and I went through a 3-day workshop on mortgage note investing. And I was hooked at that point. I just read every book on it.
What was it that hooked you?
So the fact that I felt like I could buy mortgages across the country, scalability, and that I could also receive residual income, passive income, that I didn't have to work as hard for, or I thought that was the case at the time. Okay. And so well, those two things, we'll get into that. But so it kind of met both of the two criterias I was looking for, and I went out and I put out a bunch of money and bought 10 first mortgage loans out of the gate.
Do you remember where you got those? Like how that whole deal came to pass? Was it one individual seller that you got those from, or how'd that work?
Yeah, so I bought 10 first mortgage notes in Ohio
Okay.
from the FCI exchange, which is no
Okay.
longer in service.
Right.
And they're paper stack, highly recommend. I agree with you. I actually transact sometimes on paper stack. I'm transacting now as we speak on an opportunity. So they're like paper stack is now, and they dropped that side of the business, but bought it from the exchange, and I made a very like a very large error coming out of the gate as a mortgage note investor, and
Okay.
be happy to share that with the group here.
Yeah, let's hear about it.
So you get what you focus on, like everyone's kind of heard that. And so as a landlord, I was focused on the collateral. I was focused on the property. So I performed due diligence only from the perspective of understanding the collateral, which was the property.
Yeah.
So what I ended up getting back was the collateral, and in the form of REO properties that in the middle of Ohio, which I lived 2,000 miles away from.
Yeah.
And it wasn't
REO, in case someone's listening to this and doesn't know, that just means that you acquired it through the process of foreclosure, where you were the lender and you foreclosed. Now you own it, and now it's REO.
Absolutely.
So, yeah.
And so, fast forward, it took me about 12 months to 18 months before I really figured out that it was more advantageous to keep the homeowner in their home while creating a loan modification, which is a cash flow stream for yourself and the company. And it was really kind of struck a chord because I wanted to be of greater service. So doing figuring out what people can afford, people that got back on their feet from a hardship, working with them because I purchased these mortgages at a discount. And in the end, I helped homeowners keep their home, and I helped myself and the company create 20, 30-year cash flow streams.
So is that about the term that is usually remaining when you're buying these things?
Yeah, the average term in Bquest is 22 years.
Okay.
So yeah, it's an evergreen fund, and there's no expiration to it. And we made it, we set it up that way intentionally because we want to pass it down to our children, my partner and myself.
Wow.
As well as give all the investors the opportunity to do the same.
That's really cool. So tell me a little bit about those first notes, and you're only looking at the collateral. Then you started looking at the borrower. At some point, you made a shift. It seems where you started raising other money. It's not just your own money anymore. And it sounds like if you're buying only reperforming now, and in the past, it sounds like you did your own rehab on those. You got folks reperforming. Tell me a little bit about why the switch there, and how you decided to start raising money, and what that's looked like.
Sure. So I self-funded for 7 years.
Okay.
And so, excuse me, all my own money used in creating loan modifications. And in 2017, I received a spiritual calling while I was at church, and just to share what I knew. And so I wrote Note Investing Made Easier. And I since wrote a few other additional books as well.
Oh, okay.
And
So the book is, find it on Amazon or? Okay, fantastic.
Yes. Yep. You just punch my name up on Amazon. And what I found as a result is I found other individuals that started connecting with me that, for one, they wanted to do what I'm doing as a business. And I laid out what I did as a business so they could follow those steps and create a business for themselves, which is awesome, right? If you're an entrepreneur. And I also received a lot of feedback from other individuals, high paying, high net worth individuals like doctors and lawyers. And they're like, well, I'm not looking for a business. I'm just looking for passive income.
Yeah.
And so in 2020, my partner and I, we decided to launch Bquest Funds as an income fund because we already had the mission. We already had a private fund that holds about 35 million in mortgages, right currently.
Okay.
And we already had been successful in helping those homeowners and converting them from non-performing to performing. And so what we decided is to do a legacy play for us and these investors that are also starving for passive income on a monthly basis. So we launched Bquest Funds as a vehicle to which buy these modified loans that are reseasoned from other hedge funds as well as ourselves at an 11-12% yield, even though the coupon rate, the interest rate is 5-6%. We're buying them at a discount, and which allows us to pay out 9% to investors, paid monthly on a monthly basis. Wow. Annual 9% annually paid on a monthly basis.
Right. So, 9% monthly would be a lot better, Martin. I don't know if you.
Yeah, it would be. I'd be in jail.
That's probably true. So why the switch from buying and then rehabbing those loans to buying already performing loans? And did you take did that set you back in terms of the return? Because the way the note business would work, right? If you're buying 11 or 12% yield and the coupon rate is at 5 or 6%, you're having to buy at a pretty good discount below par. And so just tell me a little bit about that, because it seems like it'd be easier to get those deals where they're not reperforming in order to get lower strike on that. So just help me understand that a little bit.
Yeah. So, if our average coupon rate, our WAC, weighted average coupon is about 7% in the fund.
Okay.
And so, we could have launched the fund that bought in the non-performing, converted them to performing. There'd be a lot more juice in the deals on that for the income fund, but it kind of moves away from the conservative nature that we wanted this fund to be. We wanted this fund to be a very consistent and predictable stream of monthly passive income for investors that they can be comfortable with.
Yeah.
And because we buy it in at a 65% investment to value, so in other words, $200,000 property, we're in that deal no more than $130K.
Okay.
So since we operate at a low investment to value, then we want to be understood as a safe place for people to park their money.
Okay. So talk to me a little bit about how you handle due diligence and mitigating risk and that sort of thing. Well, like, what does your team look like? What do you look at when you're evaluating what you want to buy?
Sure. So we have a 25-person operation in Sarasota, Florida. And so we have an acquisitions team ran by my partner, Sean. And we look at all the variables that one would look at when purchasing a non-performing note, because that's our roots, is in the non-performing. So, we're doing everything from title search, broker price opinions. We're triangulating data for fair market value. We're doing skip tracing, bankruptcy search, credit report pooling, and credit report risk analysis. And, we're merging all the data and in a pricing matrix system to go out and compete for pools of these mortgages.
Okay.
And so we've pretty much, I think over the course of 10 years, we've systematized it pretty well. Obviously, one can always get better and stronger. Plus, the economic times are changing.
Yeah.
So you have to kind of change your model accordingly. But we have a very balanced approach in the end, where we truly understand the homeowner and their ability to continue to pay, along with the underlying collateral property that's backing the promise.
And so, can you talk a little bit about where you're sourcing these? Are they institutional sales at this point, or it's not privately originated? It's not like seller
No,
financing. Yeah.
no, all the mortgages we buy are Fannie and Freddie underwritten mortgages that were originated at a major lending institution.
Okay.
Um, Deutsche Bank, PNC. I mean, you can kind of run down the list,
Yeah.
and these are these are mortgages that were sold into the secondary mortgage market in a non-performing state to a hedge fund or another lender,
I
and
see.
that lender turned that paper around to so it's performing, and then we'll buy it directly from that lender.
Okay. So, talk to me a little bit about the risks because you mentioned a changing environment, and I think that's
Mhm.
on everybody's mind right now. There's a lot of bad news out there in different markets, and so just talk about what's changing for you there. What are you doing to hedge or to guard against whatever may come, and what do
Mhm.
you see happening in your market and in your fund?
Yeah, so I think I'm a pessimistic person, so I'm always kind of like sky's always falling for me.
Yeah.
So I think bad news can be good news in
Okay.
that from an investor standpoint, in that it makes people more aware and hypersensitive to where they should park their money, and
Mm.
they should be that way anyway. However, because we were flush with cash the way we were past 10 years or 15 years or what have you, people were a little looser with their guidelines for investing.
Yeah.
And so, with that said, I always think of three risk factors that anyone should look at when they're investing in any opportunity. And I think your alt report is so incredibly powerful, just kind of bringing awareness to people on
Appreciate that.
this topic, this industry that can actually provide for people. But three risk factors: operator, who the operator is, what's your level of distance to that operator? Can you call them on the phone? I had someone, that was asking me, well, what's the difference between your fund and Starwood,
Yeah.
multi-billion-dollar fund? And I'm like, go ahead and after you get off the phone with me, go ahead and call the CEO of Starwood and ask him
Right.
the same question. It's
Yeah.
like you can't. You have no, you have no, your distance to that individual is far and stretched out. So to me, you're talking to someone who I'm the largest investor in the fund. I
Okay.
am personally largest
Yeah.
investor. My partner is the second largest investor. So
That says a
we have
lot.
we operate the fund, but we also have our money in the fund because we created the fund for us initially as a private fund. And
Right.
then we kind of opened it up to investors. So who they are, right? Like I've written books, I speak at various conferences on this subject, but these are kind of questions not about me. These are kind of the questions you want to start thinking. The visibility that an operator has out on social media, are
Yeah.
they considered thought leaders? Read some of their publications. Can you visit them? Can you go to their office and meet the team? And so can you pick up the phone and talk to the head, whomever, at any given time if you have questions? Are they responsive? What are their level of communications? Do they put out quarterly reports with financials? Do they have a fund administrator that reconciles the books and shows arm length transactions?
Hmm.
So operator. And the other one is cash preservation. Everyone wants to know, how are you protecting my capital? And what measures. So this kind of speaks to how the operator is on a due diligence standpoint. That was one of your questions,
Yeah.
but that should be a question anyone should ask when looking at an opportunity. What is the asset class? And then as an investor, how much do I know about that asset class?
Hmm.
And then what are the due diligence steps that fund takes prior to purchasing the asset to ensure they know what they're buying before they buy it? So that's important. And then, the return, the capital return, the cash flow from the
Yeah.
opportunity, kind of speaks to it. I don't like to invest in opportunities where I have to wait too long before receiving cash flow, even though it might be a value add opportunity. I
Yeah.
want to know that I'm getting monthly cash flow. That's very important to me. and I want to know the influence or control levels I have over my relationship with the operator.
Okay. So talk to me a little bit about who invests in this fund. I want to understand, a little bit more about the risk level. Let's talk about some minimums, and I think we've already hit target returns pretty good. It's 9% monthly, right?
9% annually paid monthly.
Right. Yes, 9% annually paid monthly.
Yeah.
So let's run through that stuff.
Sure. It's a $50K minimum buy-in. Average investors in for about $1.77. The maximum per entity is $1 million. We have some individuals at that level. People, about 40% of the investors come in with self-directed IRAs.
Oh.
We help people roll over IRAs from 401ks and other vehicles if they need the assistance. We have a custodian that we have a relationship with. The bulk of our investors are, and this makes me real happy, is about 70% of our investors are entrepreneurs / and or real estate investors of some kind. Oftentimes it's both. They own a business plus some real estate.
Yep.
And what that really tells me is that these are individuals that have probably worked extremely hard for their active income.
Yeah.
And now they appreciate having passive income that they don't have to think about how it was earned.
Yeah.
It's just received to them on a monthly basis. And so I think that kind of speaks to that.
Yeah. So what is the lockup like if someone invests with you?
Sure. So we have 3 classes. We have a class D that pays 6% with a 6-month lockup. We have a class B that pays 8% with a 1-year lockup. And then we have a class C that pays 9% with a 4-year lockup.
Okay.
And all of those you can compound at an increased rate, like 9 compounds at like 9.39.
Okay. And just talk to me a little bit. I want to walk back and just touch again on, we're at this weird time in the economy, and just talk a little bit about, I want to talk about the risks again and just what you're doing as you're looking out, 12 or 18 months. How does whatever you're thinking impact what you're doing to protect funds and to make sure that you continue to be able to deliver on the monthly income?
Sure. So for one thing, we look at the collectability rate on a daily basis. So, it really comes down for us to daily habits that we have as a company. And so we have a controller that produces a delinquency report. That delinquency report is issued to a particular asset manager on a daily basis. That asset manager's sole function is to make contact with the people that are slow paying or have not paid and beyond a 90-day period. And so as a result of that daily activity, we run the fund at 96.6% collectability percentage. So we have about 3.4% of the homeowners that are not paying according to schedule, if you will.
Okay.
So it's daily adherence to that report and being on top of it. And we use licensed servicers, but we also just piggyback off their efforts with our communication to homeowners.
Okay.
So that's for one. For number 2 is really having a good sense of fair market value prior to purchase. Yeah. So you can make an assessment in terms of your investment to value, and then having systems in place to ongoing monitor the fair market value, so you always understand where the investment to value sits at for your fund. Yeah. So when you do have delinquencies and you do have to initiate a foreclosure process, you understand the likelihood of recouping your capital into that investment.
Right. So I want to get I'll put a link on the page to your book, but I want to make sure that we mention it here in case somebody's driving and they hear, what is the book? I think that'd be a great way for somebody to get, deeper into this and understand who you are and if it'd be a good place for them to invest. What's the name?
Yeah, sure. A book on note investing, if you want to do this for yourself, is Note Investing Made Easier.
Yeah.
I wrote a book a few years ago called Cash Flow Dojo, which
Okay.
is a little bit more high level on how to build your home on multiple streams of income. So I'm just real passionate about multiple streams of income in general and how that's needed for American families to survive and thrive in today's economy.
Yeah.
So please pick that up. I also have a living financial statement template that people can reach out to me, and I'll be happy to send them an Excel file. It only works if you complete it and then keep it updated on a weekly basis and meet on it with your accountability partner.
Okay.
But someone can email me at martin@bqfunds.com.
Okay. That sounds really cool. I appreciate you offering that. And I appreciate you jumping on here. This makes a lot of sense, especially where we're at today. I like how you're coming in at a discount to par in where you're controlling your risk with your collateral levels. All makes a lot of sense. And I'm going to give it a hard look for myself. And thanks for coming on here, Martin. It's been great.
Yeah, thanks for having me on, Breck.